Hello, everyone. Hello, hello. Hello, everyone. Hello, hello. Okay, so good evening, everyone. So is the sound loud and clear? All right. Okay, we're gonna start at 8 o'clock. So we will check everything's like is that we're gonna make sure everything is smooth and everything is won't be like last time's like having them some echo and all those kind of the technical issue. Hopefully tonight is going to be a very smooth night. So hi everyone. Hi. So hi Sampo. Hi everyone. It's it's good to see you guys. Yeah. Right. How's everyone? The recent market is kind of volatile, so I hope you guys like has been utilize this volatility to make some, right? So for those who just joined, we're gonna start at 8 o'clock. So that make sure that you can listen me well. So like everything's like those sounds is loud and clear, and then the display is good, right? Oh yeah, Option Hunter is here. Yeah. Hi. Finally. So we'll be waiting other people to join because yeah. Oh hi. Uh Nyonya Gui. Hi. Good evening. Good evening. Thanks for spending the time to join these sections. Yeah. Would love to learn more. Thanks a lot for the class. No worries, no worries. It has been because we have received a lot of the requests to actually conduct such classes like teaching option tradings and then especially it's like for those like who already have the thesis but still have no idea how to use these kind of tools to apply into their thesis or maybe their portfolio. So yeah, we're happy to actually conduct these kind of classes to give you guys have some insight. Okay, insight of how actually option can be benefit to your trading journey or maybe your investment journey. Okay, you're welcome. You're welcome. So for those who just joined, I'm Alvin Wong. So yeah, we're gonna start at 8 o'clock. So that make sure you stay in the live. If let's say you are keen into the option trading, and then you guys can ask the questions that you want in the live sections. If I didn't manage to help address those kind of questions, Option Hunter hopefully like, can help me to address some of them. Yeah, he's been a very good option trader as well. So yeah, just because we still have 5 minutes left, and then yeah. Hi, if I miss the live session next round, is there a replay for me to watch? Yes. Resume. Yes, there will be a replay sections after I've done the live session, and I think so it's going to be takes like an hour or 2 hours for the system to lose, and then there will be a replay buttons for it, and then you can just click the replay and then rewatch it, rewatch the session over and over again. Yeah, don't worry about it. Yeah, you see, Option Hunter already start helping me to address those questions. Thank you, Option Hunter. um, it's very great to have such communities like option traders to help each other so that like we don't feel alone like in the option world. Let's chat. Yeah, let's chat. Like we still have 4 minutes. Like we can have a little chit chat. Can yeah. So like, do you guys? Just wondering, like, do you guys have faced any difficulties like in option trading, or like how many of you actually like face feels that option trading is very complex, or this kind of instrument is very complex, but you're actually very keen to actually want to know how it can actually benefit you. You know, how many of you actually feel that? Oh, okay, there's one. So new to option but keen to learn. Yeah, yeah. So did you guys actually like search like option trading on Google's like before? Like, and then how do you feel about it? Like, I just curious. Like, yes, it's the session is it will be recorded, and then there will be a replay section after the live session is done. Complex and unable to exit at the desirable timing. Okay, okay. Me too. Okay, desirable timing. It depends on the thesis as well. Sometimes it depends on the thesis. But I'll try to clear out all those kind of the foundation of the in the option derivative first, so that along the way, I hope like the whole series will be helping you to solve your pain points. Hard to understand. Hard to understand different strategy. No worries, we'll be covering it also. I'm keen on technical analysis on options like how to pivot the flow, etc., etc. Okay, okay. How do you see or draw? Okay. Want to understand the Greeks of the options. Okay. I think option done right can be safer than stock trading, but I always mess up. Yes, it's true actually. Like for your information, options is designed for as a hedge tool at the beginning, so that it should be, if you know how actually the option works, it actually can perform better than the stock trading, because like in stock trading, most of the traders will be just doing delta trading, which is like directional trading. But in option, you can do a lot of direction things like in being bullish, being bearish, or neutrals, or even like trading the range. Best if can see the strategies apply in real time, because we are starting like at eight to nine. So yeah, but I can try to give as much as the case study for you guys. Yeah, yeah. So I still have 1 minute left. Is it like 8 o'clock already? So are you guys ready? Like if you guys are ready, then I can be start the sections. So let me know. Just send me the one if you have already ready for the section. Okay, that's good. One, yes, yes. Okay, I'll got it. How's the rest? Okay, one. Thank you. Okay, so I'll be starting my sections now. So welcome to the option playbook series. And then the ideas of the option playbook is pretty simple. We just want to try to clear out all those confusion, all those kind of try to bring out what actually the options can do for you, and then how how you actually can simplify them so that you can use it in the futures, like based on your system, based on your thesis, or based on or to your portfolio as well. So before that, of course, definitely we'll go through some disclaimers to first. So there for the host throughout along the journeys, definitely we're going to have some disclaimer, because like uh we don't actually allow us to give the financial advice, so that just treat it as the whole section will be as an education guided education purpose only. It's not a financial advice. So yeah, just be aware of that. And then if you guys do hope you guys can read this kind of the disclaimer, and then so that once you have acknowledged this disclaimer, we will proceed to the sections. So okay, first of all, I want you guys to actually to give you guys some of the brief of the option playbook series. Basically, is the point is to helping you guys to master options with confidence, because we see a lot of people's like want to learn about the options, but because of the complexity, and then you guys actually kind of lose the confidence to actually like feel to use it. And then some is like you don't understand what you are looking at. You don't you look at all those kind of number, you feel confused. But don't worry, because like we are here to trying to sort it out. So basically the option playbook series will be comes in for phase. The phase one, which is what we're having today, is the orientation. There will be two chapters for the orientations. Okay, the orientation basically will like teaching you guys like what is the options, what you need to know about the options, like strike price and option change. They'll see a lot of the intimating numbers, and then what are those numbers mean. So this is the orientation, because without the foundation, you are going nowhere. Seriously, you still need to know the mechanics of the options. And the second one is that the buyer and the seller, okay, you need to know who you are in the option trading, because a lot of people's like just treat this like a stock trading, because or maybe like an investment. I'll just buy option. You actually can become a seller in the option, so that we are going to cover that under the phase one. Okay, under the phase one. So the phase two, once we have done the orientations, we will getting into the phase two, which is the income first. Because option allows you to actually generate the recurring income. At the same time, also lower down your break-even points, like using those kind of strategies that you have heard before, like cover call, cash secure put, and real strategy. Okay, so that we also be covering income strategy under the phase two. Once we have done the phase two, we will be entering into the phase three, which is maximize your capital's potentials. Basically, it's like guiding you guys how you actually can use option to create those kind of a simple spread. Some people like will be using the spread to actually generating those income without having the underlyings on it. Some people will be just doing a directional spread because they don't have the money to their account size is very small. They want to long on the direction of the based on their thesis. Say for example, if you are bullish, you can actually, but you don't have your account size is very small, but you don't want to risk so much, so that you actually can do those kind of directional spread to lower down your cost, but participate in this kind of the environment. Of course, we'll also be covering leaves as well. Once we have done this kind of the basic spread, we will move into the last phase, which is the execution mastery. Because like a lot of people is like once you enter into the spread already, then you have no idea what to do. Like in options, you actually can close. There is exercise and assignment. There's those kind of the entry exit, how you actually can do those kind of the rolling. Yes, we will be covering the execution part as well. And then once you have done complete all the option playbook pieces, I hope you guys actually have those kind of the solid foundation on how you can actually use the options to benefit to your portfolios. And then you might asking like, is this the whole option playbook series the end? Definitely no, because like we I'm still working on the option playbook, the second series one, and then which is like it's a more advanced series. Like you actually can profit from directionalist, yeah, you being neutral strategies, and then some volatility trading strategy. I'll be also covering that on the option playbook 2 series. But for now, if you're new to options, these are the very good starting for you to learn about it. So let's start. Okay, the first chapter definitely will be is called the navigating options with Moomoo, because like options is very complex things. Like you have a lot of those kind of different metrics like strike price, expiration, those kind of things. And then what we definitely need some very good tools for us to actually navigate those kind of number, and then telling us what does it actually mean. So just now I asked the questions like in the before I start, I asked you guys the questions like when you search the online, then you're like what is option, and then I want to learn about option trading. Sometimes right, you will see these kind of things, right? Like call price, risk probability, those kind of things. And some even give you some of the Greeks, and then give you some formula. So these kind of formulas tends to like scare you out. You know, like you see this kind of formula, you have no idea, and then you know ideas like what's the symbol means, and then how can I input these kind of things. But the truth is, to trade options, you don't have to be a mathematician. You don't have to be a mathematician to understand all these kind of formulas. And then you don't have to be a mathematician to understand all those kind of complex formula and Greeks. You don't. It's like driving a car, you know. It's like, because like you once you have learned how to drive, you get the license, then you just drive the car, right? You just need to know how to drive the cars. You don't need to know it's like how is the car being built, right? Like the engine, and then how to calculate the torque to get where you're going, those kind of things. You don't need to know this, okay? Just be mindful is that you just need to know how to use it, okay? A lot of people like see these kind of things, and then they just say, oh, damn, I'll just walk away. I'll just do the stock trading. So our focus here is just like skip the mechanics. We're just gonna skip like telling you how to build a car. We are going to just teach you how to drive. Sounds good? Okay. If you guys still follow, give me a 1. All right. Okay, will the basic be covered, like how to buy or sell? Yes, it will be covered. It will be covered. Don't worry. It will be covered. So let's move on to the next slide. So why you actually need to use options? Like there's 3 main purposes why you are here. The first thing is risk management, because like remember I have told you guys before I start, like option design was initially designed as a hedge tool. So they basically, the initial purpose, right? Option is act as an insurance, like if you have a portfolio, you worry that there's a huge volatility, or maybe there's a black swan event. You can actually use options to actually define your downside risk and reducing your exposure in the uncertainty market. Option can do that for you. This is the first key point why you need the options. Okay. Mainly just for investor, maybe like because like investor will be much more need hedging to go through those kind of the volatile sessions. The next one is the capital efficiency. This is more to like those mid to or even long term. I mean to all traders, because capital efficiency is like basically it's just telling you leverage. Because what options can do is like you can use a small amount of money to control a large portion of the position, so that a lot of people nowadays after 2020, a lot of people start using the option to be go for directional tradings, and then they only pays a relatively small amount, then they can make a huge high percentage of the ROI. Okay. The second thing is the capital efficiency. And then the third thing is the income generation. As I mentioned before, like you can actually use the options to generate income. Okay, it's like a property, like you already have a property, then you rent it out, and then you keep on collecting the premiums until you sell the house. Okay, you can use option to do some income generation strategies. But in today's sections, we are much more focusing on this section, capital efficiency. Because why? Because it's much more easier for you guys to understand what is option. So let's move on. So, can you guys see this comic? Basically you can treat the asset, the houses, is the stock, or maybe some of the ETF that you're investing or trading. So in this comic, it's very simple. It's like this cow is want to buy this house. He's very keen on buying this house, but he's not sure. But so that what he do, he pay a booking fees, like here's a 5,000. I want to buy the rights to buy this house at 500,000 anytime for 3 months. Okay. Basically, so now we have a setup now. We have a setup now, so that there's a house that I want to buy, so that I interest to buy this house, and then I want to having the rights to actually buy this house anytime for the 3 months. So I'm paying 5,000 to the seller. Okay, the seller say, okay, the price is locked for you. Okay, so within the 3 months time, what is the keywords in this picture? Can anyone tell me what is the keywords? You're paying for 5,000 for what? Can anyone answer me? Contracts. Yes, you are buying a contract, but buy the contract for what? You're paying yes, you are paying the premium. The 5,000 is the premium. Okay, very good. But the key point is what? What's the key points? You are paying the 5,000 premium, and then you get the contracts. The contract, yes, the rights to buy. So you are getting the rights to buy this house at the 500,000. Okay, this is the key point. So option gives you the rights to buy the houses at a certain price. In this case, 500,000 for a certain period of time. Okay, now we understand the option features, the story about it. So we move on. So now, once you have bought this contract, we call it option contract. So what happened now? I control a 500,000 asset just for 5,000. Okay. Say for example, like the spot price now is 500,000. How much I pay? I just pay 5,000. I just pay 5,000 to control these houses to buy at 500K. So there will be two scenarios at the end. If the house spike up from 500,000 to 600,000, you actually having the rights to buy at 500,000, even though the houses already pricing at 600,000. So you are making 100,000, right? So that you paying the 5,000 to buy the contract to lock the rights to buy at the 500,000. Now the houses price already spike up. It's pricing at 600,000. So you will be telling the seller saying that, yes, now I want to exercise my contracts to buy these houses at 500,000. Okay. So the seller that also have to sell to you. The seller that also have to sell the property to you at 500,000. So what you can do now, you can sell the houses for to take the profit. You make 100,000 profit, or you want to keep the houses. It's entirely up to you. Okay, it's entirely up to you. You want to keep the houses, and then you think that the houses can be can rise further, like 600,000 to 700,000 to 800,000. You can keep the houses, or you want to just instantly close the position. You want to just sell the house for 600,000 to realize the 100,000 profit. You can do that as well. Okay. So what if the property price doesn't goes up? So it goes down. Okay. So from 500,000, it goes down to 400,000. So what happened now? Do you actually lose 100,000? Do you actually lose 100,000? You don't. You don't lose 100,000, because basically you already paid the 5,000 to buy the rights to buy at 500 to buy the houses at 500k. But now the property price, the house price is already goes down, and then now it's pricing at 400,000. It crashed. This is the best part. You can just walk away. You don't have to bear the losses, because even though you are controlling the asset, having the rights to control the asset, you don't have to bear the fluctuation of these property prices. Like 500,000, it goes down to 400,000. You are not losing 100,000. Okay, it crash. You can just walk away. You only lose what? The 5,000 premium that you have, that you have paid. Okay, so now we understand it already. So that along these are the story. Basically, it's like just very similar to the in the property market. Is very similar to our option trading price. So that this is what the capital efficiency means for. Okay. Yeah, so any questions now? The max risk is only the premium, right? Even though our account is a margin account. So yes, because when you buy the option, basically you are paying the premium. That's the maximum risk you can lose. That's the max risk you can lose. Unless that you over leverage, like buying more contracts than you can afford, then that's they're very different cases. Okay. So now we move on to the next slide, which is some of the configuration. Because along the way, because I want you guys to actually know what it means by those kind of the theory. Because like along the way, I was telling you what is the strike price, what is those kind of a call and put. But I also want you guys to actually know where you can actually find them on our Moomoo platforms. How does it look like? So that you can actually memorize it better or understand it better. Okay, so before we actually start, I hope you guys can do this kind of configuration so that you're actually looking at the same setup as mine. First of all, you just search any kind of the underlines that you want to see. For example, it's like you just tap on the search first, then you move on to the just type like NVIDIA, and then any kind of a stock, other kind of a stock. Then you just tap on the option. It will move in the stock page, and then you just tap on the options, and then you can see there's a button on the right side, and then the button on the right side. Then there's a setting from it, and so you just tap on the setting. You make sure that your setup, the expiration date laid out is list view. Okay, make sure you are under the list view. The next thing is the column layout. Make sure you are straddle view. Okay, make sure you are straddle view. And then the swipe direction is up to you. In my opinion, you can if you prefer the follows, or also can if you prefer the mirror also can, because in our example I'll be just using mirror. If let's say if you just set up to mirror. Okay, for these sections. Okay. So let's move on. So in options trading, now we understand the options trading is right. Like you having the rights to actually buy or maybe sell the underlying asset. You just pay a premium, then you can buy at a certain prices within a certain period. So that in order for us to understand better, there are 5 magic questions that you actually can understand it better in option as well. So what is the 5 magic questions? The first question definitely will be, what underlying are you trading? Okay, this is a very basic one, because if you want to trade the options, right, you also need to tell me is like, what are you trading? Are you trading what a stock, or are you trading ETF, or are you trading other things? You need to have this get answer to these questions. The second thing is like, what direction do you think the price will go? And the third thing is, what price do I get the rights to buy or sell? And how much time do I think it needs to reach there? Lastly, how much does it cost me? Okay, we'll go through these questions one by one so that you can understand the option better. So the first one, what underlying are you trading? So you a lot of people have this kind of misconception saying that we just go to any kind of the underlying maybe SPY or maybe some of the ticker symbol to just like look at the option chain and start trading. Okay. But a lot of people have no idea. Actually, they need to know their thesis first. For example, it's like I'm bullish on XYZ stock. I'm bearish on ABC stock. So maybe I'm also like you being neutral on certain ticker symbol. These are the very important question because you need to know what you are trading before you actually entering into the option field. So what options, what you can trade options with, we have actually the first one, it will be stock, like those kind of Apple, Tesla, Nvidia. Those are the stock you actually can trade the options with. And the second one is like the ETF. You actually can trade options on these kind of ticker symbols like SPY, QQQ, IWM. You can trade options on this ETF as well. Okay. You also can trade the index because like we know that index, we cannot just simply buy the index, right? We only can buy like ETF or futures, right? But index we cannot buy, but we actually can trade option on the index like SPX and DAX. Okay. The next one will be futures. Futures itself is already a derivative, but the future also have the option. You actually can trade options on the future as well. The ticker symbols, like for example, like if let's say you are looking for S&P 500, you can actually trade ES options. Okay, ES, you can just search ES main and then there will be option on it. So it's a derivative of the derivative. You can actually trade that. So that now you, to keep it simple, we will just stick with the stock or maybe ETF. Okay, so that you understand it well. So what is underlying? So basically, underlying is just like what you are actually looking at those ticker symbols. Like you can actually look at this kind of ticker symbol ETF. Like we have this kind of ETF, and then you can just tap on the ETF, then you will see there is an option here. If let's say there is no option, it means that this ticker symbol doesn't have the doesn't have the option for you to trade. Okay, if you want to trade option, you have to make sure that this ticker symbol, they do offer option derivative for you guys to actually trade. Okay. So that, and then we also have, if let's say you have no idea what to trade and then but you have some expertise in some kind of a field, for example, it's like you are the expert on the consumer, you are expert on the semiconductor or internet contents, you always can go to the heat map. Okay. Go to the heat map to actually find those kind of sectors. You can tap on one of the sector, then it will show you this kind of the ticker symbol, what stock is included in the internet content. So okay, so that this one, in this way, you can actually start off with like see what is the stock you can actually start researching, and then only you move on to the options. Okay, so start with, if let's say you want to trade stock, just look at sectors. You don't know what stock to trade. Just look at the sector first. You can use the heat map to look at the sector first. Then you see what is the stock available in the within the sector. Okay. Or maybe if you just want to see the ETF, then we have the ETF filter, like the list. You can actually see all those kind of the ETF that you can trade with. Okay. So it's very important. The first question: what underlying are you trading? Okay. Some people just look at the news and then look at the news, like say, oh, gold is rising, then I'll just go gold. You can also, but if let's say you have no idea, you can use these kind of tools. So the second thing is like since for example, let's say we already decided like we want to we are bullish on SPY, maybe we are bullish on SPY. But be mindful, it's not financial advice, just for education purpose. Let's say we are bullish on SPY. Okay. And then this leads to the second questions, right? Like, what direction do you think the price will go? Let's say we look at SPY and then we think is bullish. We think it's bullish. The problem is, can we being bearish as well? Okay. Can we being bearish as well? Can anyone tell me? Like, can we being bearish as well? Like in the option trading? If let's say as much you're going to still need to deposit. Option hunter will be addressed that questions. So the second questions basically will be, what direction do you think the price will go? Sometimes you can be bullish, sometimes you can be bearish, or even you can be neutral. But in this case, for you guys to understand the options better, we're just gonna move on to these slides. So now the first question is like, what direction what underlyings do you think that you will be trading on, right? It can be stock or ETF. Since, for example, we pick a SPY, we need to have some outlook, right? We need to have some outlook so that we can be bullish, we can be bearish, we can be short. So in this case, to keep it simple, we as a buyer, if we are bullish, we want to buy the option, we will just go for call options. Okay, call options. Say, for example, if we think the underlying price is currently $100, we think the price can goes up to 20%, which means that we are bullish, right? From $100 to $120. So what options are we will be looking at? We will be looking at call options. If we have a direction thesis that we think that the $100 will go to drops another 20%, which means that we are bearish, right? From $100 to $80. So what we are buying? We will be buying put options. We will be buying the put options. Okay. So it depends which directions move on your underlyings as well. If you're bullish, you just go for a call option. If you are bearish, you just go for put options. So what is the difference between these two? Basically, to keep it simple, if you are bullish, you are betting on the underlying to go up. You're betting on, if you are bullish, you just buy a call option. Call option basically is just like you're betting on the underlying price to go up. If you are buying a put option, basically you are betting on the underlying price to go down. So remember we talked about the rise. Okay, do you guys still remember the rise? Okay. The property cases is like, is call option or put option? Can anyone tell me the property? Just now the property comic. Like, is a call option or put option? Like, can anyone answer? Call option, yes. It's a call option because like we are betting on what? We are betting on the house's price to spike up, right? So that basically the option contract is a call option because we are but we having the rights to do what? To buy, right? To buy, right? So in options, you have to understand we have two types of the options. One is call option, one is put option. For call option, as a buyer, basically buyer of the option, it gives you the rights to benefit from the price movement without the obligation to act. Basically, if we are buyers, we are having the rights to do what is very important. For just now, Rosum already tell the answer. If we are bullish, we are expecting the price to go up, we just buy the call option. Why? Because we are having the rights to actually buy 100 shares. We are actually having the rights to buy 100 shares. One standard contract of the option represent 100 shares. Remember this, one standard option contract is consists of 100 shares, okay? So to buy 100 shares, so if let's say for the property, you just buy one property, like we just refer back to if let's say you want to refer back to the comics, we just buy one property for one contract, okay? So if let's say we are buyers of the call, basically we're having the rights to buy 100 shares. If we are bearish, we are basically having the rights to sell 100 shares. Okay, to sell 100 shares. Basically means what? If let's say we are buying the put options, right? If let's say for example, you already have properties. You already have properties. Then if let's say the property price is like 100,000, then you worry that it will drop to 80,000. So you actually can buy a put option that secure at 100,000. if let's say in the futures that the property price does crash to 80,000, you still can sell at 100,000. This is what it meant. Okay, for put option. Basically, so for the put option, basically you are betting on bearish. Okay, so let's look at another comics. Like it's a very simple comic as well, and then it's just very similar to the property one. For example, it's like there's a concert. There's a concert is ahead, and then you want to lock in the price for the ticket for $150, and then you are paying for what? You're paying the strike from you're paying. Oh, sorry, you're paying the premium to the seller. Then the seller says like, okay, it's yours. It's yours to decide. It's your rights to buy the ticket at 150. So you basically, where you're betting, the ticket actually, the concert ticket actually will be specking out. So you get all those upside without paying the full price, right? You are not paying 150, you're just paying the $10. So let's say, for example, it's like eventually the ticket price will release back up to $400. Then basically you can just tell the seller saying that I want to exercise my rights and then to buy at 150. So you make the difference. So you are making the difference. So if let's say the concert nobody wanna go and then the price is keep dropping, then you just flop and then you can just walk away. The maximum loss you can lose is $10. This is call option. It's just another example of that property. Okay, just to get you guys like getting more familiar about the call options. So these are the things that you need to remember. Call option basically is having the rights to buy at your strike price. Okay, and then you are bullish, and then if you are bullish, you only go buy the call option. We call it the long call strategies. Okay, if you are bullish, then you just long a call. Some people will just buy call strategy, and then in our jargon we just say long call strategies. Okay, so in these examples, like if you are bullish, then you just buy a call options. Then in this case, we need what? We need the stock price above our strike price. The strike price is what you agree to lock, the lock price we are talking about. Okay. So if let's say the stock price is below the strike price, you can do what? You can just walk away, like this case. Okay. If you are bullish, and then the stock price is above the strike price, then you are under this kind of a scenario. You are making profit. Okay. So in put option, hold on a second. Let me see the comment section first before I proceed to the put option. Okay, maybe that one I think Option Hunter can help to answer. Okay, let's move on to the put option. Put option basically is like insurance. Remember I tell you guys, like if you worry about like your property price goes down to 80,000, then you can just buy a put option so that you can, even though the market price is selling at 80,000, you still can sell at 100,000. So it still seems like these examples, like you want to buy an insurance, like you want to get a full cashback value for 50,000 for this car, and then you just pay your $500 to the seller. So okay, the insurance seller telling you that okay, it's covered. 50,000 value is guaranteed. So actually this one's supposed to be this guy lah. Okay, you secure 50,000 of the protection just for $500. Okay. So there will be two scenarios. If let's say your car already really is it becomes a worthless scrap, then the seller basically will just pay you out for 50,000. But if let's say there no crash, so what you lose is same as a call option. You just lose the premium that you have paid. Okay, you just lose the premium that you have paid. All right. So to keep it simple, to summarize the whole put option, basically. Put option, if you buy the put option, basically you're having the rights to sell at your strike price. So what we want the stock price lower than the strike price. Basically, we are betting the underlying prices to go down so that our option contracts will be gain value. Okay. If let's say the stock price is above the strike price, okay, then you can just walk away. The maximum risk is the premium that you have paid. Okay, so in this case, if we are betting if we are bearish, you are betting the downside, then we call it, you can actually buy a put option. We call it long put strategy. Okay, we call it long put strategy. So are we clear? Okay. Okay. So what does it look like? So in the Moomoo platforms, right? When you open up the options, you will see these kind of visual. Make sure that you tap on the all for in this case. If you want to look for the call option, it will be on your left side. It will be on your left side. Okay. In the this whole features we call it option chain. Okay. In the option chain, usually the left side will be the call option. The right side will be the put option. Okay. The left is the call, the right is the put. So if you cannot understand like this where is the call, where is the put, don't worry, because you also can just tap on this one. Can you see the call here? You just tap on the call, it will show all those kind of all those call options in the apps. If you just want to look at the put, you can just tap on the put. Very simple. Okay. So yeah. Understand so far? Everyone good? Okay. So if let's say it's good, then we will move on to the next questions. What price do I get the rights to buy or sell at? Okay. Remember that we are betting on the prices, right? And then you see this kind of a strike price. And you see this kind of strike price, and then you see the 50,000 things, and then you see there is 150,000. This is the lock price, right? How much actually I getting the rights to buy the underlying ad. So this is the questions you need to ask yourself. Like, what price do I get the rights to buy or sell? So if let's say I'm a call option, I'm having the rights to buy, right? If let's say I'm buying the put option, I'm having the rights to sell, right? But at what price? Isn't that a question you should be asking yourself? Right. So what price do I get the rights to buy and sell? Okay. So buying option means that you are purchasing a rights to actually buy or sell. You have the rights, but not the obligation. So you have a call rights and a put rights. So the question is still like what I mentioned, like I have the rights to buy or sell, but at what price? So in this case, we call it strike price. Strike price is the lock price that we mentioned. Like if you think that the price can be above the certain strike price, then you can buy at a lower price for call option. If you think that the price can be lower than your strike price, then you can sell at the higher prices. Then that's a put strike. Okay. So this is the strike price, the lock price. So it looks like very complicated. Like the strike price is the fixed price which you can exercise your rights to buy or sell, and then it stays the same for the life regardless where the market move. Very very complex definitions, right? But basically, it's just a lock price. Okay, you just ask yourself a questions. What is the rights that I get to buy or sell? Just ask yourself a question. Then you will know like which strike price do you think that the underlying price will go above or below. Say for examples, if you buy if let's say the stock price is now $100, you buy $100 strike price call. Okay, let's ignore the premium first. You buy $100 strike call. So if let's say the market jumps to $150, so it still gives you the right to buy $100, right? So you are making $50. And then you have to multiply 100 shares. Remember, like one contract is equal to 100 shares. So you're making $50. So let's look at the put options. If you buy a 100 strike put, and then the markets are crashed to $50, and then the contracts give you the right to sell what? To sell, right? To sell at what price? $100, right? Because you bought the $100 strike put, right? So you're able to sell at $100. So even though the price crashed to $50, you still can sell at $100. This is basically what it means. Okay. So how do you see the strike price on the Moomoo platform? Basically, it's just at the middle there. Okay. If you look at the all, remember the left side is the call, the right side is the put. And then the middle here, you see the strike. This is the strike price. This is the strike price. Basically, what it means, if the underlying price now is what, like, let's look at this example, 693. if let's say the underlying price spike up to $700, I still having the right to buy for call option to buy at $694. Okay, if let's say $693 it goes down to 680, okay, for put option, I still can, even though the price is selling at 680, I still can sell at 694 for put options. Okay, basically this is what it means for strike price. Okay, but if let's say you still don't just want to filter out the call and put that you just want to see like call or put, and then you can always like tap on the call. You see the strike will be on your left side, and then you just tap on the put, it will be on your left side as well. Clear? Okay, clear. Everyone clear? It's just basically the lock price. Okay, don't make it so complicated with strike price and all that kind of thing. Okay, are we good? Okay. If we are good, then we just move on. Okay. In strike price, okay, we need to understand there are a few jargon that you guys need to remember. Okay. Sometimes you will see those kind of option article, they will tell you in the money, at the money, out of the money. It's very normal. Okay. Basically, I'll just tell you it's really the strike price category. Why? Say, for example, if you buy if you buy a call option that with $100 strike price, the underlying now is 120. Is the underlying price above your call option strike price? Can anyone answer me? Is the underlying prices now $120 above the strike price? Come on, let's interact some, because like so that I know you guys are following. Is 120 higher than 100 strike price? Okay. The answer is yes. Okay. 130 definitely higher than 100 strike, right? We call in this case the call option, this option particularly, but 100 strike call option, if the underlying prices is above your call option strike, is called in the money. It's called in the money. Okay. If let's say that so let's look at the put option. Okay. If the underlying prices, okay, is above the strike price, for put option is considered out of the money. Okay, because you can sell at 120. Why you want to sell at 100, right? So it's considered out of the money. At the money is very simple. It's basically just same, almost the nearest same as the strike price. The underlying prices at $100, then if your strike price is $100, it's called at the money. It's called at the money. If your underlying like is for call option, if your underlying is at $90, then your call option is 100 strike. Okay. Your call 100 strike call options will be out of the money. Why? Because you can buy at $90. Why you want to buy at $100? So it's out of the money. Okay. So for put option, it's considered in the money. Why? Because you have the right to sell at $100. Why you want to you can sell at $100 for this option while the underlying prices is at $90. So it's in the money for the put option cases. Okay, just understand that. Okay. So now we see how do we actually identify what is the in the money, what is the out of the money, what is the at the money. Okay, so in the call option, can you see the shaded blue color options? These are the call option in the money call option. Okay, can you see like now the underlying prices is what 693.42? Is it higher than 693? Yes, so it's blue. Is it the let's look at the 690. Is it the 693.42 higher than 690 for call option? That's why it's blue. Yeah. Is it 693 higher than 695? No. So that is out of the money. So it's non-shaded. Okay. So let's look at the put side. Is this 691? Okay. Is the underlying prices currently is lower than 693? Sorry. now is 693, is right. So the put option, you look at the strike price now, 691. Okay. So you want to sell at what? Sell at higher prices, right? Is the price higher than 691? It's higher, so that is out of the money. So let's look at this one. So is this strike price higher than the underlying prices? 696 is higher, right? Because so that is shaded blue, and then it's in the money. Because you can sell at 696 while your underlying prices is trading at 693. Okay. So if let's say you see this option change too complicated, you always can tap on call, and then you see the blue shaded area, it will be in the money. The non-shaded area will be out of the money. Okay. For put option as well, the shaded area will be in the money. This one will be out of the money. So what is the at the money? At the money basically is here, 693 and 694. Because basically when people talk about the at the money, right, they will just, it simply means that it's the nearest strike price to the underlying prices. It basically just means here. Okay. So now you understand, like whenever people talk about at the money, in the money, you know where to find it, what they are talking about. Okay. So let's move on to the questions. Okay. So spare me. We know that we're running out a little bit of time, but I'll be moving much more faster. So now that we have a knowledge check, and then there's some games, sorry, and then definitely I will ask you guys to actually play this game, encourage you guys to play this game. So the first 5 correct answer will get the 800 points for these questions. If let's say you guys are able to answer it faster, the first 5 people will get the 800 Moomoo points. Okay, so that the next slides will be the questions, so that I'll be counting 5, 4, 3, 2, 1. Then you guys start answer. Okay, I'll be moved to the move once I count to 0. Then I'll be moving to the next slide. Then you guys answer. Okay, can we do that? Okay. Okay. All right. So 5, 4, 3, 2, 1. Okay. Come on. The first 5 who answer these questions will get the 800 point. Okay. We have the answer. All right. Okay. So the answer is long put option, because if you believe the stock like Nvidia is going to drop from 100 to 80, which contract will give you the rights to sell, okay, is basically be long put option. Why? Because like you're having the rights to sell at the higher prices, right? You're expecting the market to drop to 80. If let's say go 80, you can sell at 100. Okay. So whoever got the answer right for the first 5 people, congratulations. So the Moomoo points, basically our back end will be do the computation for the first 5 people who actually managed to answer first, and then the points will be delivered within 21 days. Okay, will be delivered within 21 days. Okay. For those who are asking like what is the short things, right? That one will be covered in the next sections. Okay, will be covered in the next sections. Okay, so let's move on to the 4th questions. How much time do you think it needs to get there? Okay, remember that we mentioned that we buy the options, then we have the rights to actually buy the underlyings at a certain price, right? But the rights doesn't last long. It's not lifetime. When once you buy, then you have the rights forever. So that basically an options, because it's a derivative, there is the option actually had the expiration. So there is the lifespan of the option contract. Basically means that every option has a defined lifespan. Okay, some option you actually can expire like within weeklies, like every Friday. We call it weekly options. Some of them is like monthly options that expire each of the month, the 3rd Friday each of the month. And some of them, their expiration having more than a year. We call it the leaps. So basically, we have the weekly options, monthly option, and leaps. Now we even have the zero DTE options, okay? The 0-day expiration. Okay, basically you need to what you need to understand is that how much time do you think the underlying price need to reach there? For example, if we assumes that $100 stock need to go to $120, and then how long do you think it will go reach that level? You need to ask yourself this question, right? For example, some people think that within 1 week, I think it will from $100 go to down to $20. Some people think that it needs a month. Some even think that it needs a year to reach a 20% return. So it's a very fair question, right? This is what we call the time target. A lot of people doesn't consider these kind of things, like when they only have a price target. I buy at this $100 at this prices and at the spot prices $100. I put my TP target profit at $120, but they never consider the time target. How long it needs to how long it needs to take for the stock to reach $120. So this is a time target that you guys need to think. So in this case, is you just need to know is like think about it. Like how long do you think the underlying price to reach your target prices is very important. Okay, because if let's say you think that $100 $100 goes to $120, require a year, maybe a year to reach your target. Impossible you go and buy a 2 days or 3 days expirations, right? Because after 3 days, it just expire worthless. Okay? It doesn't make sense for you to buy the shorter terms, right? If you think that it will go within a years. Unless that you're saying that within this week, confirm will goes up to your price target, then you can buy a weekly option. So these are the things that you need to ask yourself when you are trading. Okay? So how to actually know the expiration? Basically, you just now your option basically will be expand. You can just tap on this expiration on above, or maybe anywhere here. It will collapse, and then you will see these are the date that the options will expire. And then if you don't know how many days left, you can see here. It will show you this is a 0 days, this is 1 day, this is 2 days, this is 3 days, and then etc. etc. Okay. So the next one, I also want you guys to understand is like there are two types of the expirations. The options are. One is that remember the exercise, right? You guys remember what is exercise already? Right? I don't have to explain it again. In American option, basically is like for ETF or maybe from individual stock. Usually they will be falls under the American options category. Basically means what? I'm having the rights to buy the underlyings, right? For example, I buying the $100 strike call options. If let's say before the expirations, the underlying prices already went above my strike price, I want to exercise now before the expiration. Can I do that? For American options, I can do that. It's like what? It's like a gift voucher. You buy a gift voucher, you can use the voucher anytime before the voucher expired. Okay, when you want to think of American options, you just think it as a gift voucher. You just buy a good gift voucher, then you can use it to redeem any time before the expire. Okay. And then another one is called European option. European option is basically like those kind of the index options will be falls under this category, like SPX, VIX, because you cannot trade. You cannot basically buy this underlying directly. Like it's not like stock. You can buy stock. You can buy Tesla. You can buy Nvidia stock. But you cannot buy SPX or VIX because these are the index. You cannot buy the underlyings. You only can trade their options. Okay, so it will fall under European option. Basically, the European options only can exercise at the expiration, and usually it will be cash settlement. You won't get the stock. It will just be cash settlement. And then when you think of European option, you just think of it like a movie ticket. If you bought a movie ticket that will be on shows tomorrow, on show on the next 2 days, can you go watch the movie tomorrow? You can't, right? You die also after 2 days also only can go to watch the movie at the particular times, right? So these are the European option. This is the European option. This is how it works. You only can exercise when at the expiration. Okay. So how do you you in Moomoo platforms like we don't have any specific things like telling you whether this is a European option but or American option. But just remember that like this kind of the SPX that cannot be traded, then you can just Google search like is the VIX European options or American option, is the SPX is American or European. But usually stock ETF is falls under American, but the indexes like SPX or VIX or NDX is falls under European options. Okay. So the last one is like how much does it cost me? So remember, like you guys also mentioned that I want to buy the options, right? I buy the options, you need to pay, right? So how much does it cost me? It's called premium. It's very simple, premium. So that in premium we have the premium is like keep fluctuating one. Okay. Say for example, if let's say the option prices now, the premium is pricing at the bid is like 4.95, the ask is like 5.05. You want to fill at the mid price in the between. So you place an order like I want to buy this option at at the mid price at $5. So $5. So you just place the order. So how much you actually paying? Remember, one contract equals to 100 shares, right? One contract equals to 100 shares. So that you need to do what? $5 multiplied 100. So your entry price will be $500. Okay. Very simple. It's just like you look at the premium, you just multiply 100, then this is the cost that you need to pay. Okay. So within the option premium, there are two technical things you guys need to remember. Okay. In options premiums, right? In option premiums, right? We have two components. One is intrinsic value. Another one is extrinsic value. Okay. Let's talk about intrinsic value. It's much more easy. Remember the in the money that we mentioned. Okay. Remember that. So if let's say my strike price is $100 for call option, okay, for call option, $100 strike price. 120 is above 100, right? Okay. So it's considered in the money, right? It's considered in the money. Then 120. So how much is the intrinsic value? It's very simple. It's just like 120, you minus the 100, you get the 20. So you're having a $20 intrinsic value. Okay. $20 intrinsic value. So if let's say the underlying prices is same as the strike price, there is no intrinsic value because 100 and 100 zero what? Is zero what? Okay. There's no intrinsic value. If let's say it's out of the money, $90 versus strike price, because it's out of the money. It's out of the money. There's no intrinsic value because you cannot just like exercise at $100 to make the profit difference, so that it's considered out of the money as well. It's zero. Okay. Because you can buy at 90, why you want to buy exercise to buy at 100, right? So it's zero. Out of the money and at the money is zero if let's say that your strike price is your call strike, your underlying prices is below your call strike. Okay, so for put option is the same as well. Out of the money and at the money will be zero. And then you can, if let's say the underlying prices is lower than your put strike is in the money, then you can calculate like how much is the intrinsic value. I can now is in the money for is $90. I can sell at $100 while the market is trading at $90. How much is it? 100 minus the 90 is $10 intrinsic value. So what's the remaining value? Okay, what is the remaining value? So the remaining value, we call it the extrinsic value. Basically, it's just telling you that the extrinsic value is the time value and the volatility value. What it means by that, like usually the longer expirations you have, the more extrinsic value you have. Why? Because like remember I told you guys the stories like if you have a thesis that the price is for example, you have a thesis like from $100 to 110. Do you think that 2 days expiration have more probability, or like 4 days expiration have more probability? Can anyone tell me? 4 days, right? Because you have more time for the price to travel to your strike price, right? Go above your strike price. So that the longer expiration you have, the higher the intrinsic value. And then there's another thing is called volatility. The more volatile the market is, the more probability your price can travel to hit above your strike price, right? So the value will be the extrinsic value basically is just the time value plus your volatility value. Okay. So how does it work? So that in this case, like we already have for example, like premium $130. We know that the $100 strike, we already knows that intrinsic value have $20. If the premium is trading at $22, our extrinsic value is how much? $2, right? Because we already know the intrinsic value is 20, then the remaining one definitely will be extrinsic value. But if let's say it's out of the money, like let's look at the put option. If let's say it's out of the money, there's no intrinsic value, right? So all this value is just what? It's just like it's just extrinsic value. So if let's say $100 to $100 is the same at the money, there's no intrinsic value, right? So all of the premium that you have paid is the component will be just extrinsic value. Okay. And then if let's say it's 80, it's very simple. It's out of the money for call, so that all of the premium is like just extrinsic value. If let's say you have you are in the money for the put option, then you have what, $80 now to $100. You can sell at $100 while is trading at $80. You have $20 intrinsic value. It's trading at 22. How much is the extrinsic value? $2. This one plus this one equal to this one. Okay, so remember that. So this is the intrinsic and extrinsic value. So when they look at the premium, they tend to ignore this extrinsic value. Okay, so that just be mindful of that. So now we can look at how do we actually look at the premium. So for call options, so now we understand strike already. We know that the expiration, so in this case, it's a 3-day expiration. How do we actually see if we want to buy? We look at what? We look at ask price, right? Because like ask is like the highest, the lowest price of the seller that willing to sell. So for this option 694 is like what, 3.82. It's out of the money, so that we know that all of these premium, that all of this strike price, all of this premium is only what? Extrinsic value. So above these prices, we know that there will be intrinsic value together with the extrinsic value. Just remember that only in the money option have the intrinsic value. Just remember that. Okay. If you want to look at whether can I just straight away see how much is the intrinsic and extrinsic, you can actually scroll here. It's somewhere here. Actually, later I'll show you the example. It's somewhere here. You can scroll, you can just see that there is an extrinsic value and intrinsic value. It's already calculated for you. Okay. So if let's say that you want to just look at call, you just look at the ask price. Remember, just look at the ask price if you want to buy the options. Okay. So the core component of the options, like you already understand, right? What underlying are you trading? For example, in this example, SPY. How much do you think that you can reach that at the expiration date? What is the strike price? What is the rise? Maybe for like 694, like for example, just now example. And then what is the direction? Are you being bullish or bearish? Call or put option? How much am I paying? $2. So basically, if you look at this kind of the option codes, right? Basically, it means underlying SPY expiration. When does the option expired? February 10. What is the rise? Do I get to buy or sell? In this case, like it's buy because it's call option, 694. How much am I paying? $2. Is it $2? No, you have to multiply 100 shares to become, so that you need to pay 200. So these are the core components of the options contract. Okay. Basically, these are all the elements that you need to understand. You don't have to calculate those kind of formula, those kind of things. Okay. So how you actually can make money is very simple. For example, like we assumes that $100 goes to $120. We are what? We are bullish, right? So that what we do, we buy a call. And then how many days we think it will go to $20, 30 days, and then strike, we just lock at $100, right? That during that time is just trading at $5, so that we multiply, that's our cost, $500. So if let's say the target hits, $100 goes to $120. $100 goes to $120, then I have what? 100 shares. You have the rights to buy at $100 at 100 for 100 shares, right? So how much is my profit? Basically, you just like the underlying prices minus your strike price. You make what? You make $2,000, right? But you need to pay the what? Pay the premium. Initially you pay the premium for this contract already, right? So you need to minus your premium. So eventually you can profit $1,500. So your cost is what? 500, and your profit is 1,500. How much is your ROI? 300%. 300%. Okay. And then what is the maximum loss you can lose? The premium, right? Remember I told you guys already? $500. But if let's say you just buy the underlines, okay? You basically, if you buy 100 shares for $100, basically you need a 10K, right? Then if let's say it went up to $120, then you'll be making 2,000. That would be a 20% of ROI. Your capital is kind of intense, and then your ROI is kind of low. And then if let's say the price does drop to $90, you are actually losing $1,000. And then during that time, you want to see whether you want to close this position or not. But in option, you just no matter how low your prices go, this is the maximum loss you'll be risking. Okay. So now we'll be moving on to the knowledge check. So this is the last question that is kind of huge, like the Moomoo point. The first 5 correct answer will get the 2,000 points on Moomoo. First 5 correct answer will get the 2,000 Moomoo points. Okay. Same rules. Okay. Ready? Are you guys ready? Okay. Are you guys ready? If let's say you are guys ready, yes. Okay. All right. So 5, 4, 3, 2, 1. Okay, let's do some calculations here. Okay. I'll give you guys maybe 30 seconds to actually answer this. Okay. You can just answer like intrinsic value is how much, and comma extrinsic value is how much. You can answer that way. Okay, we already have some incoming answer. Okay, let's see. All right. Okay. So time's up. Okay. So our back end will be do the computation. Whoever answer the fastest answer the correct answer. Sorry, the fastest people who answer answer this question correctly, then you will get the 2,000 Moomoo point. And then remember, the Moomoo point will be delivered to your accounts within 21 days. It's not immediately. Okay. Basically, you are correct. Because like Nvidia is trading at 125, you are holding a 120 strike price. Underlying prices is higher than the strike price. So you have $5 of the intrinsic value. The premium is now 8. So you just 8 minus 5, you get this answer. Do you need to calculate all these kind of things during trading? No, you don't have to, because like Moomoo in apps already got show you. Okay. So the common issue in the option trading is that there will be how can I estimate my potential profit and loss before entering a trade? and some is like the math problem. Every time, how can I see my returns, right? And then and then here comes another question: is like, is there better is there a better ways to actually calculate this without building my own spreadsheets from scratch? Okay, yes, there is. That's why we are here to teach you how to use the apps to benefit you. Okay, so let's look at the whole procedure first. First, remember these kind of the configurations, like search the underlying first. Make sure you are setting list view, shredder view, and make sure this one, if let's say preferably you guys are switched to the mirror. Okay, first of all, you need to first go to the options. Once you have searched the underlying, you just go to the options, and then by default it will expand. Your option chain will be expand. So now you can collapse this one. You can see the expiration that you want. Do you want the 4 days, 7 days, 9 days, or 11 days? Okay. Say for example, we want a 7 days expirations. We just tap on it. It will expand the whole option chain. Make sure that your bottom part is like single options. Okay. If you are not single option, just make sure you tweak that. You just tap on it. You just choose single option. Okay. So now you actually, for example, now is the NVIDIA is like 186.86. Okay. Now actually you can, we just choose to add the money, for example, 190. You can tap on the ask anyway here. It will pop up the dialog. It will just pop up the dialog. And then you can just pull up. Once you pull up, then it will tells you are buying NVIDIA, this expiration, this strike price, and call options. And then these things is called P&L analysis. Basically, you don't have to do all those kind of a calculation that I mentioned just now. Basically, you can just use this tool to see how much profit you are estimated to be making at the expiration. Okay. And then with this feature, it will also tell you the max profit. Basically, if let's say that in this case, why unlimited? Because like the price can goes up like 186 to goes up to 200, 220, 300, 400, 500, right? It's unlimited. It's unlimited. So that the max profit in this case is unlimited for call option. And then we have the max loss as well. The max loss is what? It's the premium that we paid. The premium that we paid, okay? If let's say we are get filled on the mid price, it will be $206, something like that. That is the maximum loss that we can lose. Okay. So in this graph, you also can see it's like at the expiration, how much it need to reach beyond. Remember the calculation, we also, after expiration, we get to buy at the lower prices, right? We also need to minus the premium that we pay, right? This is the premium. How do we actually calculate the break even? 192.065 basically means that 190 strike price plus 2.65. Why put 2.65? Because like that's the premium that you are paying. So you need to, so the break even point will be 192.065. The price now is 186.47. So it needs to reach beyond this level, you only can profit. Okay? You need to reach beyond this level. And then most people stop here. You actually can tap on the graph and then you move around. And then you can see the expiration profit and current P&L. Okay? If you want to look at the seller, you can press the cell to see first, but we will be covering this on the next chapter. Okay? So I'll be doing the platform demonstration now. Okay? But before that, make sure you guys actually follows the option playbook so that you can stay tuned for the next following sections. Basically, we will just cover those fundamental actionable strategy, platform tutorial walkthrough, and market relevant insight. Okay, make sure you actually follow option playbook. Okay, scan this one, and then if you haven't, okay. So so now let's pick out your phones and then use practice apply what you have learned. I'm going to use the simulator and then I'm going to actually like pull this to here. Okay. Can you guys see the platform? Are you guys looking at the platform? Yes, okay. All right. So basically what we are going to do is that what you are going to do at the beginning. For example, at the beginning pages, you are only looking at shares, right? Like watch list, you'll see your account, those kind of things. So you just go search, okay? Or maybe you can search. Then you actually can go to the pick the stock that you want. For example, like let's look at SPY. Okay, SPY. So we can tap on the SPY. So you see a SPY pages here already, right? The stock pages, you have those market cap, those kind of the metrics that you are looking. So what we want to see options, right? You see the options here, you just tap on the options. So once you enter into these pages, remember what I said, the left side is the call option, the right side is the put options. So if you just want to look at only call and put, just tap on the call. If you just want to look at the put, then just tap on the put. It will just, okay? Remember that the shaded area is the in the money, okay? The shaded area is in the money. This is out of the money. So by default it will be expand, right? You can tap on this one. Can you see the arrow here? You just tap on the arrow. It shows you all those expiration date for you. Like this is like March 17 expire, March 16 expire. How many days to expiration left? 4 days, 1 day, 5 days. Let's look at 7 days. Okay, let's look at 7 days. So that 7 days, we have this strike price available for us. And then let's say that market is down. Okay, let's say we are bullish. We think that 670 will be goes up to 67. Because the option market is only active during the regular hour. Just be aware. So that if let's say that we want to long a call that at the money, we think that it confirm will goes above like 677. Then we tap on this one. So it will pop up the dialog, and then you can press this arrow, or maybe you can pull up this dash, and then you have what? You have a P&L analysis feature appear in front of you. So now you have what? If let's say I'm buying this option, basically what is the maximum loss I will be losing? Around 800 something. The upside is unlimited, and the break even is because this one is the market haven't opened. This is pre-market. The market yesterday close is like 676.33. So it's here. How much the price need to go beyond? I only can make profit 685.228. Okay, but don't stop there. So that you actually can tap on the chart, move around, and then you will see there are two P&L appear in front of you. Can you see the expiration and P&L here? Okay, you can see, right? So what does it mean? By the expirations, right? It will only have the intrinsic value, or you either have the intrinsic value or don't have the intrinsic value. If it doesn't have the intrinsic value, basically it will falls here under here. Okay, because you buy your option will be just expire worthless. Okay, will be just expire worthless. So that the expiration P&L you can see is like 828. Okay, but if let's say that your options by the expiration is landed at, say for example, I want to know that if let's say the current underlying is for 676.33. I want to know if let's say within 7 days it goes up to like 690. 690, around 690. How much by the expiration, how much I will be making? 486. It's already calculated for you. Okay, it's already calculated for you. So you don't have to like pull up a spreadsheet and then input those kind of number. It's already calculated for you. You can move around to see the expiration P&L. And then you might wonder, the current P&L, what is that? Okay, you will see like if let's say by the expiration I need to go beyond these prices, I only can make money, right? But before the expiration, we look if let's say if let's say we look at the current P&L, you see that if we actually have profit if let's say the underlying price move up to the upside, moving to the upside. What it means by that? If let's say I'm buying this option today at these prices, if the underlying prices rise to a certain level, let's say to 680, then my option premium will be increased because of its extrinsic value. Okay, because of the extrinsic value. Extrinsic value can fluctuate as well. Okay, if let's say this rise to 680, how much we expected to be making? Our we expected to be making $215. Okay, $215. If let's buy today, if let's say I'm buying the option today, it rises to 680, I'll be making $232. Okay, this is basically what it means. But can you see tomorrow? Can you see next 2 days? If let's, because I want to see, because it would, remember, option would depreciate because remember the probability I mentioned, like 100 to $100 stock price to 110. 2 days have higher probability or 4 days have higher probability. But if let's say you are buying, 4 days have high probability, but as the time passes, your extrinsic value will be getting lower and lower, right? Because it's getting lower probability. Okay, that's why your extrinsic value will be depreciate. So that you want to look at 2 days after, 3 days after, only rise to 680. Then you guys need to install a desktop version. Okay, you guys need to install a desktop version to see that. But in the apps, it will just basically shows you, if let's say you buy this option today, if it's rise to certain level, how much my current P&L will be. In this case, like 250. But by the expiration, if let's say by the expiration, like we had 7 days, right? Just now we paid. So by this date, if let's say it rise to this level, we will be what? We will be losing money. Like expiration P&L is about 540, something like that. After expiry. So this is how you can play around with, okay, with the P&L things. So that's the whole sections for it, okay? I do hope you guys to learn some things because I know it's running out like 8 to 9, but now it's 9:30 already. sorry guys, like. And then yeah. Now do you guys have any questions? Like, yeah, do you guys have any questions? Oh, just to introduce you guys another features. If you guys want to see like how much your extrinsic premium will be changes together with the intrinsic value, how much it will be worth basically. And then you can see 677 cost, right? You pointing at the R's there, you double tap on it. Once you double tap on it, it will land you on the option pages. This particular option page, code page. Okay, you double click on it, you will see this is the option codes that we mentioned, like underlying expiration, strike price, and call put. Then you scroll down. Can you see the option calculator? The price calculator. Okay, we have American option, European option. This one is ETF, right? So we just pick American option. So I want to know now, it's like pricing at what, like $596 something like theoretically. Okay, if let's say I think that the price will go like 680, I can just input 680. I think after 4 days, after 4 days only, it will only reach these prices. So I can pick 1, 2, 3, 4. So after 4 days, if let's say after 4 days the underlying prices goes up to 680, my theoretical prices is expected to be like $7.80, which is still losing money. You can do that. You can play around with this option calculator. Okay. All right. So that's the whole sections of it. I hope you guys do actually learn something, and then some features, and then especially please practice more on the P&L, current P&L, and the expiration P&L. You can play around. Okay, and then make sure you understand what is the max loss break even and the max profit and the element. Remember the elements. Remember what we talked about, like what is the option element, the underlying, the expiration, the strike price, the call, the direction, that call and all put options. Remember that. And then we also cover the extrinsic value as well. Okay. We also cover the extrinsic intrinsic value. We also cover the in the money, out of the money, in the money, out of the money for call and put option. So that's the whole section for today. So for those who actually want to learn about the option seller, right? As a seller, how is the option seller? Just now got someone asking like, what is the short put or short call, and what is the role of being seller? That one will be the next chapter. It will be on 26th March. Okay, make sure you stay tuned. So stay tuned for the sections. Okay, all right. So wow, I see Option Hunter has been working so hard to actually address your question. Thank you, Option Hunter. All right. So, okay. So we already have our section almost ended. So like, do we still have any answer? Sorry, any answer. Any sessions like any questions? I mean, do you guys enjoy the session? If you guys do enjoy the session, please type one so that I know you guys actually understand, or maybe you can type something that you think can be improved. Okay. Yeah, thank you. I saw you one. Yeah, okay, thank you. So okay, so uh, if you still don't understand, don't worry because as we are going to have more sections. The more I share the strategy, the more you will understand how it actually works. But first, understand the mechanics of the option first, because without the foundations, you're really going nowhere. Uh, because like in the future we are going to involve like to address those questions that you are facing. Because just now like people ask like how to choose the strike price, how to choose the expiration, these kind of questions, right? Okay, got one question. If in the money auto-succession but not sufficient, what will happen? Okay, to answer your question, if you buy an option and it's in the money and you didn't close your position before it expired, it will trigger the auto exercise. But by the expiration, during the expiration date, before the market closed, before the market closed, 3 hours before the market closed, actually the dealer will be checking cross check all the account to see whether you have sufficient buying power or not. If you do not have the sufficient buying power to fulfill the auto exercise, then the dealer having the right to actually close your position. Ah, okay. Remember, it's 100 shares. If you exercise buying 100 shares of the underlying, so most option traders basically will just close their position. Uh, if let's say you don't want to get the shares, you don't want to get exercise the shares. Okay. If you close, will I? So I will profit. Depends on what price you are buying at. If let's say you are buying at from out of money and goes in the money, most likely your options is making your option premium will be at the high side, so that like potentially you are making profit. But make sure that you check your premium, because for example sometimes like the extrinsic value that you buy during that time is like very high, so it's very high cost. Say for example like you are buying a option premium that is pricing at $2, and then $4, then it goes in the money for $2. Then then because of volatility drops out, and then the time value pass by, it depreciate another $2. So eventually sometimes it will be just like break even or maybe losing some money. So you make sure you check your premium, how much premium you are buying at, and then how much premium you are closing at. That one I will be covering in the next chapter too. The next chapter will be much more focused on the buyer and the seller. What is their rights? What is their obligation? And what is the buy to open and sell to close? Okay, all right. I hope answer the questions. Okay, but if you don't understand, please please understand first, and then before you actually like pulling the trigger, because it's very important for you to understand all this. Okay, like you need to understand what you are doing, basically. Okay. Yeah, method daylight saving. Daylight saving. Yeah, that is that. Okay. All right. So we good. Okay. I hope you guys do enjoy the sections. So. Yeah. Thank you. Thank you for spending your time attending my sections. I hope you guys do learn something. And then yeah, I'll be at the sections now. Thank you guys. Thank you. And then make sure you guys follow option playbook so that you guys can see what is the next sections will be, and then when is the following session that we are going to cover, like phase 1 to phase 4. Make sure you guys follow option playbooks. Okay? All right. So I'll see you guys. Happy hunting, guys. Happy hunting.